Hi, John. How are you today?
I'm good, Elliot. How are you doing?
I'm good too. I was on vacation last week, as we talked, and it was very restful. And now, back catching up. But that's part of the cost of going on vacation.
Yeah, back catching up and realizing we have to be strong about defending our law enforcement partners from verbal and physical assault, unfortunately. But that's for another podcast or webinar.
Yeah, but fully agree with that. So when I got back, I was looking at email and things, and I noticed that the Federal Reserve issued a new supervisory letter, 22-6, that's focused on how banks and other banking organizations, things they should think about when they're engaging in activities related to crypto assets. I wonder if you saw that.
I did, and I think it's pretty important to note that all the banking agencies, obviously in the Treasury Department, have been pretty vocal about crypto-related issues for a couple of years. So obviously, there's both a concern and a interest in staying ahead and staying educated. So this is definitely consistent with that. So I think that they built off the statement, that interagency statement that was issued a few months ago. And as you said, that the Fed has this specific supervisory letter. And I noticed a couple things about it. In our world, it talks about how the crypto asset sector can pose risks for a whole host of things, but including money laundering and terrorist financing. And that is also something that we continue to struggle with, both law enforcement and our community, because as they say in the letter, crypto assets have limited transparency. So sometimes very difficult to track ownership. So that's one. But obviously there's a number of other areas that they think are risky.
Yeah. So as a starting point, I thought it was interesting to use the phrase crypto assets, and then they have a bunch of footnotes. And in the definition, it's very broad. It's sort of anything that uses cryptography technology. So we're talking about, not just the currencies, but other forms of crypto assets that are becoming available in the marketplace. They also talk about the need for organizations to have the technology capability and the operational capability to manage the risks that arise from being in this space. They talk about, reminding everybody that banks need to operate in a safe and sound manner, and that they have consumer protection obligations, all of which they have to look at these new activities that they're getting into or evaluating through those lenses.
Right. And in terms of stability, they specifically call out stable coins. And they said that's adopted at a large scale. That also poses a risk to stability through runs and disruptions in the payment system. But going back to your point on consumer protection, that's always an issue for the financial sector, right? To make sure you're protecting your customers, but they have a whole list of things that they believe are potential negative aspects of crypto assets: fraud, loss of assets, again, compliance risk, and a whole host of things. So, clearly they've been doing a lot of work in this space and just trying to make sure that financial institutions are going into this with their eyes wide open.
Yes, absolutely. Another piece, and it's not the core of what you and I normally talk about, but because this is a supervisory letter, they do remind institutions, both bank holding companies and banks that they supervise, that those institutions need to work their way through the authorized activity analysis. So because each of the different types of crypto assets and the activities you might be involved with, whether it's custody or facilitation of customer purchases and sales, loan collateralization using crypto assets, or payment related activities, you need to work your way through the various regulations that apply to you and determine whether it's a permissible activity. And then, to the extent it is, follow the rules, whether it's advance notice and approval, or notice within so many days of starting, or requesting clarity that it isn't a permissible activity. They also point to everybody to the fact that there are possibly state laws that may apply or other federal law, because again, at the moment, in the US, the SEC is viewing cryptocurrencies, at least in some situations, as to be securities. So you've got an entirely separate regime of regulation that you have to be aware of, and that's again a compliance risk issue.
You know, we talked about this before our conversation, and that's the process of alerting your regulator, your examiner, to what you're doing. And it's always sort of been my view that regardless of what the regs or the particular product is, it certainly makes a lot of sense from a communication standpoint, if nothing else, but certainly from a legal standpoint when required, to alert your supervisor as to new products and services. I mean, we also have always debated internally, making sure the compliance staff is well aware of something before you release a product to the public, which used to be more of an issue than I think it is today. But I also looked at this statement as the notification part of it is sort of twofold, right? The notification is let let your supervisor know that you're engaged in crypto asset related activity if you already are and you haven't done that yet. Obviously, let them know if you're planning to, but also they say in the statement that the Federal Reserve staff will, not should, will provide relevant supervisory feedback as appropriate in a timely manner. So putting a little bit of the onus on the regulators to say, hey, this is what we're planning to do. This is what we put in place. To your point, here's all the laws and regulations that we think cover what we're trying to accomplish. And then getting that, I'd say more than feedback, but getting that response back from your regulator. And as you also mentioned, if there's a state issue, the state member banks are encouraged to notify their state regulator. So the bottom line is this is sort of both sides have an obligation here. I think a lot of this happens generally already, but I think this is pretty clear. This is much more important given the confusion about crypto assets, and some crypto assets are equal, some are not, that sort of thing, than any other product. So as I look at that, I'm taking that as a direction. Open up the lines of communication broader than they've ever been. Make sure you have that day-to-day dialogue with your examiners and your supervisors, and just make sure you know exactly what you're doing before you decide to go down this road.
Agreed. Yeah, when I was at a financial institution and involved in dealing with our regulators on an ongoing basis, particularly in anti-money laundering space, but across the board, our standard approach was no surprises. You don't want the regulators to first find out you're doing something new, and particularly something new that is of high visibility and under a lot of scrutiny when they first show up at the next exam. You should be able to have a communication channel open, as you discussed, and be able to walk them through the process you're going through to evaluate the risk, to get your compliance and operations teams on board, how you're going to explain it to the customers, how you're going to put the guardrails around what you are going to do and what you're not going to do, and how you're going to manage all that. And that process is good discipline for really being ready to launch a new product, whether it's something as new and potentially complicated as crypto assets, or whether it's something that's a more traditional mainstream product that you haven't offered before.
Yeah, and I would just end my part of this by saying, as I look at the statement, the one thing I would have done differently is I probably would have underlined this one sentence that's sort of in the middle of it, and that's given the heightened and novel risks posed by crypto assets, the Federal Reserve is closely monitoring related developments and banking organizations' participation in crypto asset related activities. That's clearly, obviously, what they're doing, but that's why communication is just so essential.
Yeah. So my last comment would be that they also call out in the supervisory letter that this guidance applies to banks and bank holding companies of all sizes. So sometimes there are things that apply only to the smaller bank holding companies or only to the larger, meaning over $10 billion dollars in assets. But this one clearly calls out that it's all bank holding companies. And I think the scrutiny of smaller institutions will likely be higher because of the concern about whether they actually have the operational capability to get into some of these more complicated spaces.
Yep, that makes sense. Just as we close this down, I just want to remind folks that August 25th at 1 o'clock Eastern Time will be our next live webinar, and that's on AML, CFT, and transparency. What are the challenges? We will discuss the global focus on transparency, also the status of some US-based legislation, specifically regarding what we're calling euphemistically enablers. And so we will have a practicing lawyer formerly from the Justice Department, as well as a staffer from the Transparency International, has done a lot of work in this space. So that is, again, August 25th, 1 o'clock Eastern Time.
Okay, John, I know you're going to travel a little bit, so drive carefully to your next event, and we will talk next week.
Sounds good. Take care.
All right. Bye-bye.